Hello, this is Rochelle Agatha, and this lecture is on fixed assets. Fixed assets are also known as property, plant, and equipment, or PP&E, and there are several objectives in this lecture. We want to learn how to define and classify and account for the cost of fixed assets, compute depreciation using several different methods, journalize entries for the disposal of fixed assets, compute depletion and journalize the entry for depletion on intangibles, describe the accounting for intangible assets such as patents, copyrights, and goodwill. Describe how depreciation expense is reported in the income statement and prepare a balance sheet that includes fixed assets and intangible assets. Let me just say that as you've probably noticed starting in the accounts receivable chapter, that the accounting is just getting more complex. It's not that we're doing much more than what we did in the first set of lectures where we learned how to do accounting. Now we're just building on the concepts of accounting, and we're pulling apart the balance sheet and the income statement and learning how to account for things. And fixed assets are relatively complicated, and companies that have a lot of fixed assets are highly scrutinized from an auditing standpoint. So that's why it's important to learn how to follow these objectives when we account for fixed assets. So we're going to learn how to define, classify, and account for the cost of fixed assets. Fixed assets are long-term or relatively permanent assets. They are intangible because they exist. They are tangible because they exist physically. They are owned and used by businesses, and they are not offered for sale. So it's not something that you're holding for resale. It's part of your normal operations. So here's just a little chart of fixed assets as a percent of total assets from selected companies, so that you can see that different types, manufacturing firms are going to have a huge amount of fixed assets. Service firms won't, just the nature of the business. So when we classify costs, we ask ourselves questions. Is the asset purchased, is the purchased item long-lived? If it's no, then it's an expense. If it's yes, then you ask yourself, is the asset used in the productive purpose? If it's yes, it's a fixed asset. If it's no, then it's an investment. There's certain types of asset classifications, and the cost of acquiring these are added to the cost when you put them on your books. So for land, you're going to take the purchase price, the sales taxes, permits, brokers' commissions, title fees, etc. So you're going to add all this stuff up, and you get to put it all in the initial cost of the land when you put it on your books. For buildings, similar thing, the cost of acquiring the building, you get to include all of that as the capital asset, which becomes important later as we talk about depreciation. Machinery and equipment, same type of thing. Taxes, freight, installation, reconditioning, insurance while in transit, etc. Land improvement, that would be things you do to land, infrastructure, trees and shrubs, fences, etc. So these are all the things you get to include in the cost of acquiring a fixed asset. Things you exclude: vandalism, mistakes in installation, uninsured theft, damage during unpacking, fines for not obtaining proper permits, things that are operational in nature. The lecture defines capital and revenue expenditures. You'll also hear me refer to revenue expenditures as operating expenses. Expenditures that benefit only the current period are called revenue expenditures, which is kind of a ironic title, I think. In real life accounting, practitioners such as myself just call those operating expenses. Expenditures that improve the asset or extend its useful life are called capital expenditures. Revenue expenditures, normal and ordinary repairs and maintenance, those are operating expenses. Capital expenditures, additions, improvements, extraordinary repairs. The biggest way to remember the difference is, does it extend the life of the asset? If it does, it's a capital expense. If not, it's an operating expense. So ordinary repairs and maintenance are booked to repair and maintenance expense and either cash or accounts payable, depending on how you pay for it. So this is a revenue expenditure, or what I would call an operating expense. Asset improvements, say you bought a $5,500 hydraulic lift, it was installed on a delivery truck. So you're improving the asset and possibly extending the life. Then it goes to the value of the truck and cash. So it's a capital expenditure. So the difference is something that's ordinary and repair-like in nature is an operating expense. If it adds to the value and it can be used over time, then it's a capital expense. An extraordinary repair, the engine of a forklift that's near the end of its useful life is overhauled and it costs $4,500. This extends the useful life. That's a capital expense. So you're actually going to take it out of accumulated depreciation and pay for it because you're extending the useful life for an extraordinary repair. Here's a nice little diagram when you print out your slides. This one I think helps you understand. You have an expense, and if it only benefits the current period and it moves along the top and it becomes a repair and maintenance. If it benefits current and future periods, it's capital, and then if it's asset improvement, it adds to the service value of the asset. If it's an extraordinary repair, it extends the asset's useful life. So there's two avenues for a capital expense. So on June 18th, GTS Company paid $1,200 to upgrade a hydraulic lift and $45 for oil change. Journalize the entries. Okay, so you have the delivery truck and cash. Then you have repair and maintenance for the oil change. So there's your difference, even though they both happened at the same time. A capital lease is accounted for as if the lessee has in fact purchased the asset. And there's been a lot of accounting changes around capital leases over the years, and businesses were trying to operationalize capital leases and just expense them, and you can't do that. If it meets the terms of a capital lease and the criteria of a capital lease, you have to book the asset as an asset. A lease that is not classified as a capital lease for accounting purposes is also classified as an operating lease. So then they would be expensed. The second objective is to compute depreciation using several different methods, and this is the meat of this lecture. So you're going to want to print these slides out and make sure that you can do this on your own, and that's why there's so much homework related to this lecture. Depreciation is basically over time, fixed assets such as equipment, buildings, and land improvements lose their ability to provide services. That periodic transfer or loss of life is called depreciation, and that is how you expense an asset over its life. Physical depreciation occurs from wear and tear while in use and from the action of the weather. Functional depreciation occurs when a fixed asset is no longer able to provide services at the level for which it was intended. The three factors that you need to determine depreciation are the fixed asset's initial cost, its expected useful life, and the estimated value at the end of the useful life. The fixed asset's estimated value at the end of the useful life is called the residual value, scrap value, salvage value, or trade-in value. So there's several different terms. As you all know, you're going to buy something, and in the end of its life, it still has a value, even though you've depreciated it. A fixed asset's residual value and its expected useful life must be estimated at the time the asset is placed in service. So here's your initial cost, and this is like a little diagram with your residual value and your depreciable cost. So just a little picture. As you can see, for the most part, most companies use straight line. There's reasons to use the other methods, but for the most part, most businesses use straight line depreciation. The straight line method provides for the same amount of depreciation expense for each year of the asset's useful life. So you take the cost less the estimated residual value divided by the life, and that's your annual depreciation. And then you book it monthly and divide it by 12. So here's an example. A depreciable asset costs $24,000. It has an estimated residual value of $2,000, and an estimated life is 5 years. So you take your cost minus your residual value divided by your life, and that gives you annual depreciation of $4,400. Very straightforward, very simple, easy to do the math, easy to keep track of. So you might want to ask yourself, where do we get the 5 years? From an accounting standpoint, asset types have basic lives, and if you're going to go into practice, you'll find this. But equipment, it's like a car, 5 years, stuff like that. There's basic years that you use. The straight line method is widely used by firms because it's simple, as I mentioned. So here's another example. You had equipment that was acquired for $125. It had a $5,000 residual value, and it had a 10-year life. So we're going to figure the depreciable cost is $120,000. The straight line rate, if you will, is 10% because it's 10 years. So 1 divided by 10 is 10%. Lots of people like to work in percents. Other people like to work in fractions. It goes both ways, so you get comfortable with whatever you need. And the annual amount is $12,000, which is the 120 divided by 10, or the 120 times 10%. The unit of production method is used in areas where equipment is producing something, so it provides the same amount of depreciation expense for each unit, but it varies on the number of units. So you take the cost less the residual value divided by the estimated hours or units. So let's say you have an asset that costs $24,000. It has an estimated residual value of $2,000, and it's expected to have an estimated life of 10,000 hours. So think about a manufacturing firm. Maybe it's a stamping plant. You have a stamping machine, and it can stamp for 10,000 hours. That's the type of scenario. So you're going to take your cost less your estimated residual value, 24,000 minus 2,000, divided by your 10,000 hours, and you're going to have a $2.20 hourly depreciation. So then the unit of production method is more appropriate than the straight line when the amount of use of a fixed asset varies from year to year. So here you have a cost of an asset of 180 with a residual value of 10,000, and it has a useful life of 40,000 hours, and it was operated for 3,600 hours. So you're going to take your 170, the 180 minus the 10, divided by the 40,000 hours is 425 an hour, times the 3,600 hours. The first year is 15,300. So then each year you would just use that 425 times the number of hours, and you cannot depreciate it beyond the maximum number of hours. That's something to keep in mind. The double declining balance method provides for a declining periodic expense over the estimated useful life. It's called an accelerated method, and it is twice the straight line rate. So a shortcut to figure it out, that's why we did the percents a minute ago. If you have a 5-year life asset, that's a 20% asset. Double declining balance would multiply that by 2 and use 40%. So for the first year, you're going to take the 40% times the book value and then decline that down each year. So let's use an example of the $24,000 asset with the $2,000 residual value. So the first year, you're going to have 24,000 times the 40% rate. Now, the key to this one is, notice we don't back the 2,000 residual value out to start with. You just don't depreciate down below that. So we start with the 24,000 times the 40%. Then the second year, you have a book value of 14,400 times the 40% gives you the times 40% gives you the 5,760. So each year, notice your book value is going down, and that's what you start with at the end. So at the end of the first year, here's the book value. Then you start with that. You decline it down. Notice the annual depreciation is getting smaller over time. That's why it's called the double declining balance. Then at the very end, this was a 5-year asset. You have to stop your depreciation when your book value equals the residual value. Notice right here, you went beyond that. So what you do is you back into that last year and you force the annual depreciation so that you can't go beyond the residual value. That is the difference. Honestly, from an operational standpoint, I've never worked for a company who uses this, but it is a method that is available. And why would you want to do this? Because you're going to take depreciation on the front end a lot greater than on the back end. So, you know, if you choose this method, you have to stick with it. And what you're telling yourself is you're probably going to make more revenue off this equipment from the front than you would on the back. That would be the only reason I would choose to do it. So here's another one where you have a $125,000 asset with a $5,000 residual value, and it's 10-year life. So there's your your depreciable cost is the 120. Your rate is twice the straight line rate, so it's 1 divided by 10 times 2. And the first year depreciation is 20% times the 125. So here's a nice little chart that just kind of compares the depreciation methods for you. You can print it out, and it's like a note, you know, something you can study from. Notice here the difference in the methods is straight lines right across even, double declining balance goes down, but in the end, the total depreciation on the asset would be the same. Just for real quick, you're going to take tax accounting if you're an accounting major, but so you know that income tax depreciation rates are different. They have a MACRS, Modified Accelerated Cost Recovery System, and it specifies 8 classes of useful life and depreciation rates, etc., and it does vary, so that just keep in mind that your tax depreciation will not necessarily tie to your book depreciation, and that we have a chapter at the very, very end where we talk about what we do with that difference. If you revise your depreciation estimates, let's say you bought a $140,000 asset with a useful life of 5 years, and the asset had been depreciated for 2 years. So you had your 140 minus your 10 divided by your 5 years, so you had 26,000 per year. After 2 years, you had a book value at the end of the second year of 88,000. Okay? Then all of a sudden, the company decided that it really had an 8-year useful life. So what you would do is you would take that $88,000 at the end of the second year and revise it so that you would have a remaining depreciation cost of $80,000, and then you would divide that by 8 years, and you'd have $10,000 left per year. So just to show you that that does happen. I mean, people do revise what their assets' useful life are. I don't think it's very common, but you need to know how to do it. So let's deal with a warehouse that cost $500,000. It had a residual value of $120 and a useful life of 40 years, and it's depreciated by straight line. Determine the amount of the annual depreciation, the book value at the end of the 20th year. If at the start of the 21st year, it's estimated that the remaining life is 25 years. Okay, so we have $500,000 less the salvage value divided by 40. Then we had 20 years at that $9,500. Gave us a book value of $310 at that point, and then you're going to take the $310 minus the $150 and divide it by the 25 years total, and now you're going to get $6,400 a year. So just to show you mathematically how you would do that. Now we're going to talk about journalizing entries for the disposal of fixed assets, because there are a lot of times you do dispose of fixed assets, either excuse me, because you sell them or you just get rid of them. A piece of equipment acquired at a cost of $25,000 is fully depreciated. On February 14th, the equipment is discarded. So you're going to take it out of accumulated depreciation and take the equipment off your books. That's how you get rid of it off of your books. You write off discarded equipment by taking it out of accumulated depreciation. You take both sides off your books. Remember, the asset sits on your books at the original cost. Equipment costing $6,000 is depreciated at an annual straight line rate of 10%. After adjusting entry, the accumulated depreciation had a $4,750 balance. So you're going to take the adjustment against accumulated depreciation to record current depreciation on the equipment discarded, and I got that $150 by taking the 600. The 10% times the 6,000 is 600 times 3/12. Then you're going to discard the equipment once again by taking it out of accumulated depreciation. You're going to have a loss on disposal of fixed assets because the equipment was on your books at $6,000. So you actually have to record a loss. What I tell students to do, there's a lot to remember in this. When you do your journal entry, put what you know, and then the difference is going to be your gain or your loss. So it's easy. You knew what your equipment balance was. You knew what your accumulated depreciation was. The difference then, you have to put something here. At least get your journal entry in place, and it'll start to make more sense to you. So here, let's do another one. You sold a fixed asset for $10,000. Cost $10,000. It's depreciated on a straight line rate of 10%, and you sold it for cash on October 12th. The accumulated depreciation had a balance of $7,000 and needs to be updated. So first, you're going to take depreciation expense for that almost 10 months. So you can take 10,000 times 3/4 times 10%. That's how you get your $750. Then you're going to sell it for $2,250. So there was no gain or loss. You're going to get cash, take the accumulated depreciation off the book. So here's your net book value. The difference between these two is the $2,250, and there's the cash. So this is an example where you sold equipment at book value. Let's say it was sold for a loss. So in this situation, you're going to put what you know. Okay, I'm going to get it all up here so I can show you. What you would do is, you know what the equipment is on the books for, you know what the accumulated depreciation is on the books for, you know what you got in cash because they told you. So the difference is loss. So it's not as hard as it looks if you plug the pieces you know and then leave the part you don't know and then logically think about it. Now we sold it for a gain. Same kind of thing. We got cash at $2,800. We know what the accumulated depreciation was. We know what the equipment was, and the difference is gain. Now let's do one more example. Equipment was acquired at the beginning of the year. It cost $91,000. It was depreciated using the straight line method with an estimated life of 9 years with a residual value of $10,000. So we want to find out what the depreciation for the first year is. Assume the equipment was sold at the end of the second year for $78 and journalize the entry. So first we're going to find the amount of depreciation for a year. Then we're going to figure out after 2 years we sold it for $78. So we have a $5,000 gain. And this is how we book the entry. So print these slides out and walk through them and make sure that you really can do this on your own and use them as help when you do your homework. When old equipment is traded in, you often the seller gives you a trade-in allowance. For the old equipment, the remainder is called the boot. It's an old term that's been around forever. It's either paid in cash or recorded as a liability. Important, you do not get to record a gain on an exchange of a fixed asset in your financial statements. So let's use this example that we sold. New equipment was being purchased, had a list price of $5,000. We did a trade-in. We got an allowance of $1,100, and the old equipment cost $4,000 and had a book value of $800. So you have two choices of methods. It depends on how you like to do stuff. So method one, you take the list price, you take the trade-in allowance less the book value of the old equipment, and that's your unrecognized gain on exchange, and then you get the cost of the new equipment. I think method two is probably easier. You take your book value and you add what you paid in the exchange, and that's the cost of the new equipment. You can use method one or method two. Notice they both came up with the $4,700. So here's your journal entry for your exchange. Notice that that you don't get to record a gain. Okay, you take it out through the transaction. For financial reporting purposes, you do recognize losses though. So here's another example. You had old equipment with a cost of $7,000 and a book value of $24,000, and you gave a cash payment of $8,000. So here's the cost of the old equipment, the accumulated depreciation, here's the book value, the date of the exchange, here's the trade-in, here's your loss. So you're going to put the pieces you know on your books. Whoops, sorry. So here's your hang on, having mouse issues. Here's all the pieces I know: the cash, the equipment, the loss, the equipment, the new equipment, and then the accumulated depreciation. So on the first day of the fiscal year, a delivery truck with a list price of $75,000 was acquired in exchange for an old delivery truck and $63,000 cash. Determine the cost of the new truck and journalize the entry. Okay, the old truck had a cost of $50,000 and accumulated depreciation of $39.50. So you have A is your list price, and there's your trade-in allowance, less your book value is your unrecognized gain on exchange, giving the cost of the new truck at $73,500. Or you can do it the other way. Book value of the old truck plus the cash paid at the date of the exchange is the cost of the new truck. So I think this one's probably easier, but you need to know how to kind of do it both ways. And here's your journal entry. We're going to talk about depletion and what depletion is. The process of transferring the cost of natural resources to an expense account is called depletion. So you don't deplete depreciate natural resources, you deplete them. So if you think about like an oil field, as the oil goes away, you deplete it. Or you think about a forest, as the trees are cut down and sold, you deplete them. So a business paid $400,000 for mining rights to a mineral deposit estimated at 1 million tons of ore. The depletion rate is 40 cents per ton. Okay. So what you do is you book your adjusting entry in depletion expense and accumulated depletion. So it's like depreciation. We use separate accounts. Here's another example with a mining company where they had rights of $45 million for 50 million tons, and during the current year they had 12,600 tons mined. So first you're going to determine the rate, then the expense for the current year, and do the journal entry. So you have 90 cents per ton. So the first 12,600 tons at 90 cents is 11.34 million, and there's your entry. Now we're going to describe the accounting for intangible assets such as patents, copyrights, and goodwill. Patents, copyrights, and trademarks and goodwill are long-lived assets that are useful in the operations of a business. These assets are called intangible assets, and they are long-term. They don't physically exist. The exclusive right granted by the federal government to manufacturers to produce and sell goods is a patent, and these rights continue in effect for 20 years. So at the beginning of the fiscal year, you're going to amortize a patent. So you have your patent amortization. This one had a remaining useful life is 5 years. So this is what we do. Notice that because a patent does not exist physically, it's acceptable to credit the asset. This is different from fixed assets. Okay, so there's not an accumulated amortization. It goes right against the asset. The exclusive right granted by the federal government to publish and sell literary and artistic and musical composition is called a copyright, and copyrights extend for 70 years beyond the author's death. A trademark is a unique name or term, a symbol used to identify a business and its products. Most businesses identify their trademarks with their advertisement on their products. Trademarks can be registered for 10 years and can be renewed every 10-year period thereafter. And then there's goodwill. It refers to an intangible asset of a business that's created from such favorable factors as location, product quality, reputation, etc. So think about this. If you created, Apple, and then you sold Apple, there's a huge piece of the business that is goodwill because of the name that it has. So it's an intangible because you can't touch it. People are willing to pay for businesses, even service businesses, because of the name that they carry. Generally accepted accounting principles permit goodwill to be recorded in the accounts only if it is objectively determined by a transaction. So it's basically like somebody has to come out and say there is goodwill and where the number came from. A loss should be recorded if the business prospects of the acquired firm and the acquired goodwill become significantly impaired. So loss from impaired goodwill. So you put goodwill on your books and it just sits there, and at some point, if there's it doesn't really seem to be there anymore, then you have loss from goodwill. You don't amortize goodwill. So here's another example where we want you to journalize the adjusting entry. So you're going to have your loss from your goodwill and your goodwill because it's impaired. And then you have your amortization expense of your patent. So notice the difference. You don't amortize goodwill. You just have loss from goodwill as it's impaired. Describe how depreciation expense is reported in the income statement and prepare a balance sheet. So the amount of each major class of fixed assets should be disclosed in the balance sheet and the notes. The fixed assets may be shown at their net amount. So you could have your office equipment less your accumulated depreciation is your net book value. This is what you're going to see. The cost of mineral rights or ore deposits is normally shown as part of the fixed assets section of the balance sheet. And intangible assets are usually reported net of amortization in the balance sheet in a separate section immediately following fixed assets. So here's a nice example. Notice that you have all your different types of fixed assets with your accumulated depreciation and your book value. And then you have your mineral deposits. And then you have your total property, plant, and equipment. Remember I said PP&E, that's what people that are in accounting tend to call it, or fixed assets. Then you have your intangibles. So that's what it looks like. Okay, we have a couple of ratios. We have our fixed asset turnover ratio. It measures the number of dollars of revenue earned per dollar fixed asset, and that is revenue divided by average book value of fixed assets. So here's an example for Marriott International, your fixed asset turnover ratio, and then you just compare yourself to other people in the industry like yourself, and you compare yourself from year to year. So for every dollar of fixed assets, Marriott earns 4.88 of revenue. So in summary, we learned how to classify fixed assets, the different types. We learned the depreciation methods. We learned how to journalize related entries. We talked about depletion, intangibles, and financial statement presentation. I realized that I spoke pretty fast on this. There's a lot to cover. Please print out the slides and go through them. Make sure that they make sense to you. Then attempt your homework and let me know if you have any questions. Thanks.